Hello, my name is Abigail Soto, and I will be reading this presentation of asset purchases versus expenses. What are assets? Assets are resources with economic value that an individual or business owns with the expectation that it will provide future benefit. Examples: property, equipment, investment. The types of assets: there are tangible assets, like physical assets you can touch, such as machinery, buildings, or vehicles. Intangible assets: non-physical assets, such as patents, copyrights, trademarks, etc. There are also financial assets, which are investments like stocks, bonds, or cash equivalent. Characteristics of assets: long-term value. Assets are expected to provide benefit over an extended period beyond 1 year. Ownership: they are owned or controlled by the entity and can be used to generate revenue. Examples of farm assets: land, equipment, infrastructure, buildings, animals, money in the bank, accounts receivable, which are the unpaid invoices, and inventory. Asset purchases: when a business purchases an asset, the business retains the value of the asset. A business can purchase an asset outright with cash, in which case the value is converted from cash to the asset. A business can also purchase an asset by taking a loan to finance the purchase, in which case the business holds debt that corresponds with the value of the asset. Asset purchases: on the left, it's before you purchase. You have cash of 100,000, and then the farm purchases a tractor for 50K. So the resulting value is cash of 50,000 and other assets, which is the tractor of 50,000. On the right, before the purchase, you have cash of 100,000, but the farm takes out a loan for 50,000. You have now a cash of 150,000 and a debt of 50,000. And with that, the farm decides to purchase the tractor for 50,000 with the loan that it received, which results in a cash now of 100,000, other assets of 50,000, which is the tractor, and debt of 50,000, which is the loan. What are expenses? Expenses are the costs incurred by a business or individual in their ongoing operations to generate revenue. They are typically used up to or consumed within a short period to support the business activities. Examples of farm expenses are like seeds and plants, fertilizer and spray, animal feed, pest management, supplies and packaging, wages and payroll, phone and internet, marketing, permits and licenses, vehicle and mileage, fuel, repairs and maintenance, rent and mortgage, utilities, licenses and certifications, and interest expenses. Types of expenses: there are operating expenses, which are day-to-day costs of running a business, like salaries, rent, utilities, etc. And there are non-operating expenses, which are the costs not directly related to the core operations, like interest expense or losses from the sale of an asset. Some key differences: purchasing an asset is an investment in the business that is expected to provide future benefit. The accumulation of assets over time increases the value of a business. For example, if a farm purchases a tractor, the value of that tractor contributes to the overall value of the business. If a farm takes 50K from its bank account and uses it to buy a tractor, the cash leaves the bank account, but it retains the 50K, but now in the form of a tractor. As the tractor ages, the value decreases through depreciation. This is discussed in a later slide. Um, an asset is also something that could be sold to recoup some of the value. Continuing, expenses represent costs incurred through operating the business as well as in the process of generating revenue. Example, a farm buys seed every season. Without the purchase of seed, there would be no product, no sale, no revenue. So while seeds are a cost, they are a necessary cost to generate revenue. Once an expense is made, the funds are gone. Unlike assets, there is nothing tangible left to resell. In the example of the seeds, it would be unlikely that a farmer would ever resell the seed that they purchased. Note for farmers who produce seed crops, they sell the new seeds they grow, not the original seed. Depreciation. The gradual reduction in value of an asset over time. Depreciation ties the cost of using a tangible asset with the benefit gained over its useful life. It spreads out the cost of the asset and slowly reduces its value over time. Straight line depreciation formula. It's the purchase price minus salvage value divided by useful life in years, which equals the depreciation expense per year. For example, depreciation of a tractor. You purchased the tractor for $25,000. The salvage value is $5,000, which is the approximate value after the complete depreciation for a 10-year useful life. The calculation would be 25,000 minus 5,000 divided by 10 years equals 2,000, which is the 2,000 is the depreciation expense per year. So here's an example how your accounting would look before any depreciation is taken. Your income statement, the income is produce sales of 10,000, total income of 10,000, expenses, which is the seed purchase of 300, packaging purchases of 500, which gives you a total expense of 800, and a net income of 9,200. Your balance sheet, your asset, which is the bank account of 14,200, equipment of 2,500, giving a total asset of 39,200, liabilities, the equipment loan of 25,000, the equity, which is the owner's capital of 5,000, and retained earnings of 9,200, giving you a total liabilities plus the owner's equity of 39,200. After a year of depreciation, nothing changes. You're just calculating the depreciation. Your income statement is your income, which is the produce sales of 10,000, giving you a total income of 10,000. Expenses, which is the seed purchase of 300, the packaging purchase of 500, and now a depreciation expense of 2,000, giving you a total expense of 2,800 and a net income of 7,200. Your balance sheet is now the assets, which is the bank account of 23,400, which is year one bank account plus the depreciation expense plus year two net income. An accumulated depreciation of negative 2,000, giving you total asset of 46,400. Your liabilities are the equipment loan of 25,000, the equity, which is the owner's capital of 5,000, retained earnings of 16,400, which is year one retained earnings plus year two net income, giving you a total of liabilities plus owner's equity of 46,400. In conclusion, assets and expenses play distinct roles in financial management. By properly categorizing and managing them, businesses can optimize their resources and achieve long-term success. Thank you.